All right, guys, so here it is, the last video before we are now, before we move on or in the chapter, sorry. All right, so we're talking about decisions for transfer pricing. So it says materials used by the instrument division of export industries are currently purchased from an outside supplier at a cost of $210 per unit. However, the same materials are available from the components division. The components division has unused capacity and can produce the materials needed by the instrument division at a variable cost of $160 per unit. So it's asking us to figure out A, B, and C. So it says if a transfer price of $180 per unit is established, or AKA negotiated, and 60,000 units of materials are transferred with no reduction in components division current sales, how much would export industries' total income from operation increase? How much would the instrument division income increase? And then the same thing for the components, all right? So as I mentioned in the last video, maybe take a snap picture of this. I'm gonna flip to a blank screen so we can work this problem together, okay? All right, so again, I'm a visual learner, so I like to draw pictures. So what we have is the export, there it is. So we have export, right? Industries, that is the name of the company. And under export industries, you have two different, I guess, divisions they have. They have the components division. So they have the components division and they have, sorry, I'm losing my instrument. Okay, so sorry guys, I'm gonna erase this really quick because I want it to line up beautifully. All right, so you have the instrument division, instruments, and then you have the components, right? And so it sounds like in reading through this, the components department can supply the instruments department with what it needs, right? And so right now, the instruments department is currently buying their stuff from an outsider supplier. So I'm gonna just put this here. They're buying it from a supplier at a cost of $210, okay? And now they said that the components division, they their variable cost is $160, right? So what I can tell you right now is anything between $160 and $210 is a win for both parties, right? So they got to settle in between that. All right, but in the first one in A, it says if a transfer price of $180 per unit is established, so the instrument department is willing to buy it for 180, and then they're willing to sell it for 180. So this is their commonality, right? It's a win for both of them. It's $20 above what their variable cost is, and then on this side they're saving what, $30, right? They're saving $30 because if you do 210 minus 180, that comes out to $30, right? So it's a win-win for both of them. So they're asking us how much will each division save and then the overall company, right? Now we're talking about a total, we're talking about a total of 60,000 units. So that's what's at stake right now is 60,000 units, right? So if looking at it from the instruments perspective, if they can buy it from the components division for 180 versus the $210, how much are they saving? Well, they're saving $30. 30 times 60,000 units, right? So we're going to do that calculation. So $30 in savings times the 60,000 units that they're talking about, that is a total savings of $1.8 million. Okay, so that's the instruments. Now for the components department, their variable cost is 160,000 and they're going to sell it for 180. So that is $20 above their variable cost. And again, what's in question is 60,000 units. So you're going to do $20 times the 60,000 units, and that will give you a total of $1.2 million in profit for the components department, division, right? And so lastly, it's asked, so in A, it's asking us, what is the company overall saving? Well, you're just going to add these two up. If you do 1.8 million plus 1.2 million, that gives you a savings of $3 million. Okay. So hopefully that made sense to you. But we just broke it down on how much each division is saving by selling or buying from each other. Okay, then negotiate it, and then you need the units. All right, last but not least, we got to talk about the last component, which is the cost price approach. And so this is used to set transfer price. There's a variety of approaches within this approach. So you can set the price based on total production cost per unit. So like direct labor, direct materials and factory overhead is included in the transfer price. So basically, if it costs me $30, so in the last example is a good example. In the last example, we only considered variable costs, but in under total cost, it considers all of them. It considers direct materials, direct labor, and factory overhead. So it includes your fixed and variable costs. And then the next approach you can do is variable cost per unit. And so it considers everything except fixed factory overhead costs is excluded. And then you have actual costs. It can be based on actual costs, or your standard costs may be used. Now, it's very important if you're going to be using standard, if you're looking at actual costs, I think or the book states that it's a better use to do standard costs, because we know that sometimes there's inefficiency. So going back to chapter 8, if you have direct labor variances or direct material variances and so forth, you don't want to work that into the price of the product to another division. You don't want to make them pay for your inefficiencies. So you want to price the product at the standard cost, what it should have cost to produce that product. So the cost of price approach is most often used when the responsibility centers are organized as cost centers, okay? So hopefully that made sense to you guys, but that is the end of this chapter. If you have any questions or comments or concerns, please let me know. Otherwise, that's it for chapter 9, and I will see you guys for